The audit opinion on financial statements is critical to the public's trust because it provides an independent and expert assessment of the accuracy, reliability, and fairness of an organization's financial information. This opinion is issued by external auditors who review the company's financial records and practices to ensure compliance with accounting standards and regulations. When auditors provide a positive opinion, it signals to stakeholders such as investors, creditors, and the general public that the financial statements are reliable and transparent. This assurance helps build confidence in the organization's financial health, ethical practices, and overall credibility, fostering trust in the information presented and influencing important decisions made by stakeholders. In contrast, a negative or qualified opinion could raise concerns about the accuracy of the financial information, potentially eroding trust and affecting stakeholders' willingness to invest, lend, or engage with the organization. In this discussion, we will talk about the need for assurance, users' demand for reliable information. We will also discuss the differences between assurance services versus attestation versus auditing. We will talk about the standard setting environment, different types of audits and the auditors who conduct those audits, and we will conclude with the different types of certifications that can be obtained. Why do we need assurance? One reason is the potential bias in providing information. Potential management bias in the financial information underscores the critical need for assurance services. While responsible for preparing financial statements, management may have incentives or pressures to present information in a way that benefits their interests. This bias can lead to misrepresentation, manipulation, or selective reporting of financial data. Assurance services play a crucial role in mitigating this risk and promoting the integrity of financial information by validating and verifying the data's accuracy, reliability, and transparency. Assurance professionals use their expertise to exercise independent judgment while evaluating financial information. Their objectivity helps uncover hidden biases that management might introduce intentionally or unintentionally. Additionally, the involvement of an independent third party in the assurance process enhances the credibility of financial information. Stakeholders such as investors and creditors are more likely to trust information that has undergone an external review. Assurance is also needed because of the remoteness between users and the organization. The concept of remoteness between a user and an organization refers to the physical or informational distance that exists between stakeholders and the organization's operations and financial information. This distance can create a lack of direct insight into the organization's activities, making it challenging for users to assess the accuracy and reliability of information. Assurance bridges this gap by providing an objective assessment that ensures information reliability, accuracy, and transparency, regardless of the physical or informational distance between stakeholders and the organization. For example, stakeholders may lack direct access to its operations, internal controls, and financial records. Assurance services provides an external examination that compensates for this limited access, ensuring that stakeholders receive reliable information even when they can't directly verify it. Stakeholders might not have a deep understanding of the organization's internal processes, systems, and controls. Assurance helps bridge this gap by evaluating the effectiveness of these internal mechanisms and ensuring their reliability. There's also a risk of misrepresentation. When users are far removed from an organization, there's an increased risk that they might receive incomplete, inaccurate, or biased information. Assurance services offer an independent assessment that helps detect and mitigate potential misrepresentations. Organizations are complex structures. Organizations with complex structures, subsidiaries, or global operations can be difficult for users to fully understand. Assurance provides an objective evaluation of consolidated financial information, helping users navigate complex reporting scenarios. It is also important for users to have confidence and trust. Remoteness can create uncertainty and skepticism among stakeholders. Assurance services enhance confidence and trust by offering an independent and expert evaluation of the organization's financial information. Finally, complexity also drives the need for assurance. The complexity of transactions and information systems drives the need for assurance due to the challenges it poses in assuring the accuracy, reliability, and security of financial and non-financial information. Assurance services provide an external expert evaluation that helps stakeholders navigate these complexities and make informed decisions based on trustworthy information. Challenges include the increased risk of errors and fraud, complex transactions involving multiple parties, intricate calculations, and various variables can lead to errors or intentional misstatements. Assurance services help detect inaccuracies and fraudulent activities within these complex systems. Data integrity and reliability. Complex information systems often involve data from different sources, databases, or platforms. Ensuring the integrity and reliability of this data becomes more challenging. Assurance verifies the accuracy and consistency of financial reporting and decision-making data. Interconnected processes. In complex organizations, processes are often interconnected, and errors in one area can propagate throughout the system. Assurance evaluates the effectiveness of internal controls and risk management strategies to prevent and detect such errors. Emerging technologies. Modern businesses rely on emerging technologies like artificial intelligence, machine learning, blockchain, and big data analytics. These technologies can introduce new risks and complexities that require specialized assurance to ensure accurate results and prevent biases. E-commerce and online transactions. Complex online transactions, especially in e-commerce, involves various parties, payment gateways, and cybersecurity considerations. Assurance helps verify the authenticity of transactions and the security of customer data. Non-financial information. Complex information systems also deal with non-financial data, such as environmental, social, and governance (ESG) data. Assurance ensures the accuracy of this information, which is increasingly important for stakeholders interested in sustainability and ethical practices. The demand for reliable information is driven by the information risk that users face. Information risk refers to the possibility that the information available to stakeholders may be inaccurate, incomplete, or misleading, leading to uninformed or incorrect decisions. This risk arises due to errors, biases, fraud, or data collection and processing limitations. The concept of information risk directly drives stakeholder demand for reliable information. For example, informed decision-making. Stakeholders such as investors, creditors, and managers rely on information to make well-informed decisions. If the information is not reliable, decisions might lead to undesirable outcomes. Reliable information reduces the uncertainty associated with decision-making, mitigating potential losses, and facilitating better choices. Market confidence. Accurate and reliable information contributes to a healthy and well-functioning market. When stakeholders trust that the information presented is trustworthy, they are more likely to participate in market activities, leading to greater market liquidity and efficiency. Information risk emphasizes the potential downsides of relying on inaccurate or incomplete information. Stakeholders demand reliable information to mitigate these risks and make informed decisions that align with their goals and interests. The independent assurance of reliable information helps build confidence, trust, and credibility in the organization, benefiting both the organization and its stakeholders. Auditing attestation, and assurance engagements are interconnected concepts within the field of accounting and financial reporting. They involve various levels of evaluation, verification, and validation of financial and non-financial information. Assurance engagements encompass both auditing and attestation engagements. They involve providing stakeholders with confidence in the accuracy, reliability, and credibility of information. Assurance engagements can extend beyond financial data to cover non-financial information, such as environmental performance or data security. The goal of assurance engagements is to offer an independent evaluation and opinion on the information's accuracy, compliance, and adherence to relevant standards. For example, an assurance engagement related to non-financial information might involve a sustainability report issued by a company. A third-party assurance provider is engaged to assess the company's sustainability performance and the accuracy of the information presented in the report. The assurance provider reviews data related to environmental impact, social responsibility initiatives, and corporate governance practices. They then issue an assurance report stating whether the information is reliable, accurate, and in compliance with established standards. Attestation engagements are a broader category that includes both auditing and other assurance services. Attestation involves providing an independent assessment, assurance, or opinion about various types of information or assertions beyond financial statements. This can include examining an organization's internal controls, financial forecasts, compliance with specific laws and regulations, and sustainability reporting. Auditing is a subset of attestation engagements specifically focused on financial statements. An example of an attestation engagement would be a certified public accountant, a CPA, providing assurance on the management's assertions about their organization's internal controls over financial reporting. The CPA assesses the effectiveness of the controls, tests their implementation, and issues an attestation report expressing an opinion on whether the controls are suitably designed and operating effectively to prevent or detect material misstatements in the financial statements. Auditing is a specific type of assurance engagement. It focuses on examining an organization's financial statements and related information to express an opinion on their fairness, accuracy, and compliance with accounting standards. Auditors assess internal controls, perform substantive testing, and provide an audit opinion which states whether the financial statements are presented fairly in all material respects. Auditing primarily deals with financial information and is often associated with external audits required for public companies. The Sarbanes-OXLEY Act of 2002, referred to as SOX, is a United States federal law enacted in response to a series of major corporate accounting scandals that occurred in the early 2000s, involving companies like Enron, WorldCom, and Tyco. SOX aims to enhance the accuracy, transparency, and reliability of financial reporting and improve corporate governance and accountability. Under SOX, management holds significant responsibility for the accuracy and integrity of a company's financial reporting. One of management's prime responsibilities under SOX is certification of the financial statements. Specifically, the CEO and CFO must certify in the company's periodic reports that they have reviewed the financial statements and that they fairly present the company's financial condition and results of operations. They must also affirm the effectiveness of internal controls and disclose any significant deficiencies or material weaknesses. The objective of placing substantial responsibility on management to maintain the accuracy, reliability, and transparency of financial reporting is to prevent accounting fraud and enhance investor confidence by ensuring that management is actively overseeing financial information quality. Another key provision of SOX was the creation of the Public Company Accounting Oversight Board, referred to as the PCAOB. The PCAOB plays a crucial role in overseeing and regulating the audit of public companies in the United States. Their primary functions include setting auditing standards. They're responsible for establishing auditing and related professional practice standards for the audits of public companies. Those standards guide auditors in conducting thorough and accurate audits that provide reasonable assurance about the reliability of financial statements. The PCAOB also conducts regular inspections of registered public accounting firms that audit publicly traded companies. These inspections evaluate the quality of the firm's audit practices, internal controls, and compliance with PCAOB standards. The goal is to ensure that auditors are consistently meeting high-quality standards. The PCAOB has the authority to take enforcement actions against audit firms and individuals that violate PCAOB rules, standards, or SOX. This includes issuing sanctions, fines, and disciplinary action for deficient audit work or unethical behavior. Public accounting firms that audit public companies are required to register with the PCAOB. Registered firms must adhere to PCAOB standards, undergo inspections, and provide annual reports to the PCAOB detailing certain information about their audit practice. The PCAOB's oversight activities are designed to protect investors and enhance the credibility and reliability of financial information. By ensuring that audits are conducted with rigor and independence, the PCAOB contributes to maintaining investor confidence in the capital markets. While the focus of this course will be on the audit of financial statements conducted by external auditors, there are a variety of audits and the auditors who are responsible for conducting those audits. Financial statement audits are conducted by CPAs or chartered accountants with expertise in accounting and auditing standards. The purpose of these audits is to provide assurance on the accuracy, fairness, and compliance of an organization's financial statements. As an example, a CPA firm is engaged by a publicly traded company to audit its annual financial statements, including the balance sheet, income statement, and statement of cash flows. The auditor verifies that the financial information is presented fairly and in accordance with generally accepted accounting principles, GAAP. Internal audits are performed to assess the organization's internal control, risk management practices, and operational efficiency, as well as to identify areas for improvement. These audits are often performed by internal auditors who work within the organization, and they often hold certifications like Certified Internal Auditor, CIA. An example of an internal audit would be an internal audit team in a manufacturing company conducts an audit of the production process to ensure that quality controls are in place, inventory is managed effectively, and operational procedures are followed. Information technology auditors have expertise in technology systems, data security, and IT controls. The purpose of these audits is to evaluate the organization's IT systems, data integrity, cybersecurity measures, and compliance with regulations. An example of an IT audit would be one where an IT audit firm is hired by a financial institution to assess the security of its online banking platform. The audit evaluates data encryption, user authentication, and protection against cyber threats. Compliance audits are performed by industry-specific experts or regulatory compliance professionals. The purpose is to determine if an organization is adhering to applicable laws, regulations, and internal policies. An example would be a compliance audit is conducted at a pharmaceutical company to ensure that its manufacturing processes comply with regulations set by the FDA. Operational audits are performed to assess the efficiency and effectiveness of specific operational areas, identifying opportunities for cost reduction and process improvement. These audits are generally performed by operational experts with knowledge of the organization's processes and industry. An example would be an operational audit is performed at a retail chain to evaluate the efficiency of its supply chain management processes including inventory management and distribution. Forensic audits are performed to uncover and document financial misconduct, fraud, or other illegal activities within an organization. These audits are generally performed by forensic auditors who are experts with specialized skills in investigating financial irregularities, fraud, and disputes. They often have a background in accounting law, enforcement, and investigative techniques. An example of a forensic audit is an auditor is hired by a company to investigate allegations of embezzlement involving a senior employee. The forensic auditor examines financial records, interviews employees, and gathers evidence to determine if any financial wrongdoing has occurred. Governmental audits are performed on governmental agencies and programs to ensure compliance with legal requirements, financial accountability, and effective use of public funds. These audits are performed by governmental auditors who work for government agencies or audit firms specializing in public sector audits. They are knowledgeable about governmental accounting standards and regulations. An example of a government audit would be a governmental auditor working for a state's audit agency reviews the financial records and expenditures of a local school district to ensure that taxpayer funds are being used efficiently and that the district is in compliance with applicable laws and regulations. These are just a few examples of the types of audits and the auditors involved. Audits play a critical role in providing assurance, improving processes, and enhancing transparency across various aspects of an organization's activities. Upon completing your accounting degree, there are a number of opportunities available for certification in different fields of accounting and auditing. The most prominent certification is the Certified Public Accountant. The CPA is a licensed professional in the field of accounting. CPAs have met education, experience, and examination requirements set by their jurisdictions, accounting regulatory body, which is typically a state board of accountancy in the United States. CPAs are authorized to perform a wide range of accounting, auditing, tax, and financial advisory services for individual businesses and organizations. They are known for their expertise in financial reporting, taxation, and compliance matters, and they often provide valuable insights and guidance to help clients make informed financial decisions. Accountants with expertise in management accounting can also be certified as a CMA, a Certified Management Accountant. A Certified Management Accountant is a professional certification for individuals working in management accounting and financial management roles. CMAs have demonstrated expertise in financial planning, analysis, control, decision support, and professional ethics. The CMA certification is awarded by the Institute of Management Accountants, IMA, and is recognized globally. The CMA designation signifies a strong foundation in accounting and finance, as well as the ability to provide strategic insights to organizations. Accounting professionals specializing in internal auditing can obtain a Certified Internal Auditor certification. The CIA is a professional designation offered by the Institute of Internal Auditors for individuals who work in the field of internal auditing. The CIA designation signifies expertise in internal audit practices, risk management, control processes, and governance. The CIA certification demonstrates a commitment to the highest standards of internal auditing excellence.